Welcome to Talk Tickers, your deep dive into the numbers and narratives driving the market. Today, we're cracking open the analysis of Independent Bank Corp, ticker INDB. This follows their third quarter 2025 earnings call, which just wrapped up on October 17th.
Yeah, in this deep dive, it's really all about validation, isn't it? For the last year, management's been telling the market the closing and, integrating the huge Enterprise Bancorp acquisition. That was the key. Q3 was meant to be that operational inflection point.
Right. The big question hanging over every regional bank investor was, could the synergies, the margin expansion they promised, could it actually happen? And could it overcome, frankly, what everyone expected to be a tsunami of merger noise and one-time costs?
Well, judging by the market's reaction, the answer seems to be a pretty clear yes. This wasn't just meeting expectations. It looked like a clean operating beat. Suggests the whole thesis is, well, providing concrete returns, maybe even faster than people thought.
Okay, let's get into those hard numbers then, the ones that sparked that positive reaction. Because with INDB this quarter, you really have to separate the official GAAP figures from the underlying operating performance. What were the headlines?
So the operating earnings per share, that's the number that strips out those one-time costs, it landed at $0.55. That just edged out the Wall Street consensus, which was around $1.54. So that low $1.55, that's the figure that shows the core business is, humming along.
But then you look at the official GAAP EPS, dramatically lower. It came in at just 0.79 cents. That's a huge gap. What exactly was driving all that noise, as you called it?
It was mostly those non-recurring integration expenses. I mean, you had $23.9 million in M&A costs, which, okay, that's expected, but still significant. But more importantly, there was this hefty $34.5 million day two CECL provision. And that was tied specifically to the loans they just bought from Enterprise.
Okay, wait, I need to stop you there. Just for the listener, can you unpack that CECL provision a bit? Day two sounds like they had to immediately set aside reserves for loans they just acquired. Was management flagging some kind of credit quality issue there?
Not necessarily a hidden issue. It's more about regulatory conservatism, really, applied to a new portfolio. The current expected credit loss rule, CECL, it forces banks to estimate losses over the entire life of a loan right up front. Management confirmed this specific day two provision was largely, a one-time accounting adjustment tied to expected future credit costs inherent in that book, not some immediate stress they found. It's really just part of that merger cleanup.
Okay. That framing makes sense, less concerning. And yeah, when you look past that accounting noise, the operational strength, it really does seem undeniable. Operating return on average tangible common equity ROTCE, that's a metric the big investors watch closely, right? It jumped a stunning 283 basis points to 13.2%.
That ROTCE number, that's the real validation point, I think. It shows the acquisition is already adding to high-quality earnings, and the revenue story backs it up. Net interest income, NII, surged to $203.3 million. That's up almost 38% just quarter over quarter. Huge jump. And non-interest income was strong, too, grew almost 18% to $40.4 million.
And crucially, you mentioned management specifically called out a meaningful drop in the efficiency ratio. That's really the first concrete sign that those promised cost savings of synergies are starting to hit the bottom line.
Exactly. The machine is getting leaner, even while it's getting much, much larger.
Okay, let's move past the pure metrics for a second and dive into the human story behind this. Integrating Enterprise was this massive hurdle. How did they manage to pull it off so smoothly?
Well, smooth might even be underselling it. The Enterprise systems conversion completed successfully in Q3. That's usually the point where things can go sideways, right? Customers get frustrated. But what really sets this deal apart, I think, is the cultural piece. The talent retention.
Yeah, tell us more about that, because losing your key commercial lenders after you buy a bank, that can just destroy client relationships overnight.
They managed to keep almost 100% of the client-facing commercial people and all the targeted wealth management staff.
Yeah.
That's almost unheard of in a deal this size. And there's this unique factor. Enterprise's former chairman and founder, George Duncan, he's still actively involved. He's an advisor to the board, an advocate for the combined bank.
Wow. Keeping the founder of the bank you just bought around and actively engaged. That feels like old school community banking loyalty. You almost never see that in these big M&A deals. That must mean client attrition is likely minimal too, because the people they trust are still there.
And you see it immediately in the numbers. That cultural fit, the retention, it led to tangible results. Those enterprise bankers, their loan originations in Q3 were 27% higher than the same period last year. So they didn't just stick around. They hit the ground running on the combined platform, started producing right away.
That's a really powerful narrative. Okay, let's shift gears to the margin story. because that was the other huge promised benefit, right? Net interest margin, NIM, improved significantly to 3.62%. That's up 25 basis points quarter over quarter.
Yeah, the 25 basis point lift, it looks fantastic. But we need to dissect it a bit, right? How much was like core underlying earnings power and how much was that temporary boost from purchase accounting?
I was just about to ask the same thing. So out of that 25 BP's expansion, what was the breakdown?
Okay, so about half of it was that purchase accounting effect. Specifically, around 8 basis points came from purchase loan accretion, and another 5 basis points came from purchase discount accretion on the securities they acquired. So 13 basis points were essentially transactional boosts related to the deal math.
So doing the math, roughly 12 basis points came from genuine underlying operational improvement, which is still excellent, don't get me wrong. But the other half is, like you said, a temporary revenue stream. For the listener, what exactly does purchase loan accretion mean and why isn't it sustainable long term?
Think of it like this. When INDB bought Enterprise's loans, they had to mark them down to their fair market value at the time of the deal, usually a discount to the face value. Accretion is simply recognizing the difference between that discounted purchase price and the loan's full payoff value. They recognize it as interest income over the life of the loan. It gives a fantastic boost to NIM right now, but it naturally burns off. It fades over the next, say, 5 to 7 years as those acquired loans mature or get paid down. It's basically pulling future income forward.
That's a really crucial distinction. It helps validate the price they paid for Enterprise, sure, but it means that organic growth engine has to rev even faster down the road to replace that fading boost.
Exactly right. But look, they're building on a really solid funding foundation. Total deposits swelled to $20.3 billion post-deal, and crucially, their cost of deposits was incredibly well contained. It only went up 4 basis points quarter over quarter to 1.58%. That really shows the immense value of that legacy Rockland Trust deposit franchise. Sticky, low-cost funding.
And their core deposit base, that remains a strength too. Non-interest-bearing demand deposits, DDAs, they still make up a healthy 28% of overall deposits. Having that much low-cost funding in this kind of rate environment, that's a massive competitive edge.
Absolutely. Now, moving over to the loan book, obviously the total book jumped way up to $18.5 billion because of the merger, but we really need to focus on where they're generating organic growth now.
And the focus there seems pretty clear. Commercial and industrial loans, C&I. Organically, C&I loans grew at a strong 13% annualized rate this quarter. That's where they seem to be leveraging that expanded footprint and maybe some of the new specialty businesses they picked up.
That 13% annualized C&I growth, that's a huge signal. It shows the integration isn't just done, it's actually generating new business momentum almost immediately. Now, contrast that with their commercial real estate portfolio, the CRE book.
Right. Their CRE loan balances actually declined organically at about a 6.7% annualized rate. And management was clear. This wasn't just market drift. It was an intentional shrinking of some transactional CRE business.
And that intentionality, that focus, it paid off big time in hitting a major regulatory target. Post-acquisition, their CRE concentration level landed at 295% of capital. Now, you have to understand for the listener, that 300% level is a key threshold. Go above that, and you get heightened regulatory scrutiny. So getting below 300% despite absorbing all of Enterprise's CRE, that's a massive display of capital discipline and risk management. Really impressive.
Yeah, that's a major de-risking event for the stock, especially with all the lingering fear around regional bank CRE exposure. And on asset quality more generally, things look pretty solid. Non-performing assets were just 0.35% of total assets. But what about that specific bogeyman office real estate exposure, the thing that keeps investors up at night?
Well, management sounded, frankly, more confident about resolving their existing office credit issues than they did, say, 6 months ago. And they give some clear examples of active management, which I think helps de-risk that whole narrative for investors.
Okay, what were those specific examples?
They mentioned a $27 million relationship that was recently renewed for 2 years. But critically, the borrower had to inject fresh equity. That shows the borrower still has skin in the game, right? They're committed. They also mentioned another $16 million office loan that's potentially heading towards a sale. So this isn't just waiting and hoping. It looks like active resolution work.
Good detail. And just to close the loop on quality, they also confirmed negligible exposure in that non-deposit financial institution space, NDFI. That's another area of specialty finance risk that seems to be off the table for them.
Absolutely. So if we pivot now to the forward view, management explicitly called Q3 an important stepping stone, their words, towards better growth and profitability. The next few quarters seem to be all about realizing the rest of those promised synergies.
And we're already seeing some immediate expense benefits. They're projecting core expenses will drop by about $2 million in Q4 alone. That represents the first tranche of those realized cost saves flowing through.
And importantly, they reaffirmed their original, pretty ambitious guidance, achieving 30% cost saves on the entire enterprise expense base. They expect that to be fully realized during the first quarter of 2026. So that means more efficiency gains are still ahead of us. Plus, those one-time M&A costs, they're finally winding down. Only about $8 to $10 million expected in Q4.
Okay, looking specifically at their Q4 guidance, they're anticipating low single-digit percentage growth in both loans and deposits, starting from the September balances. Seems reasonable.
Yeah, and their adjusted NIM guidance was reaffirmed too. They expect another 4 to 6 basis points of core expansion. And remember, that excludes the impact of that volatile purchase loan accretion we talked about. So that indicates they expect genuine underlying margin improvement to continue, probably driven by good deposit pricing.
They also seemed a bit more upbeat on future organic loan growth. They bracketed the potential rate going forward at low to mid single digits. And that's definitely an improvement from their previous guidance, which was just low single digits. That C&I success story seems to be changing their tune a bit.
And capital discipline was another huge win this quarter. The tangible book value, TBV, dilution from the Enterprise deal, it actually came in lower than they initially expected, about 7%, versus the original estimate of 9.8%. That reduction in dilution, that's a major boost to the long-term valuation case.
And they're actively putting that capital to work. They bought back around 365,000 shares for $23.4 million under their current authorization. With their long-term target for CET1 capital around 12%, they still seem to have significant room for more capital deployment. Suggests more buybacks could definitely be on the table.
Just one final housekeeping note. They are gearing up for a full Bank Corp system upgrade, slated for May 2026. They estimate about $3 to $5 million in one-time costs related to that prep work will hit in Q4. But despite pulling off this huge integration so well, management was very clear. They are not focused on more M&A right now. The priority is finishing the current integration and really maximizing those organic opportunities they see.
Okay, time for our favorite segment. Just a reminder, this is purely for entertainment, a conceptual discussion based on the data we just went through. This is absolutely not financial advice.
Right. So the central fact here seems to be that the successful integration proven by that lower TBV hit and the synergies starting to show up has meaningfully de-risked INDB's balance sheet and their operational path forward. Now, the stock reacted positively, sure, but it's still kind of tethered to that general pessimism and volatility that's just plaguing the whole regional bank space. It's only doing modestly better than the sector ETF, KRE.
Yeah, the operating bridge seems crystal clear now. You've got NIM lift plus those efficiency gains, which should equal higher earnings, and that theoretically should warrant a higher valuation multiple over time. So let's pitch a strategy hypothetically to maybe maximize return based on that operational clarity while also maybe monetizing some of the market's leftover fear.
Okay, here's a trade idea. Go long INDB common stock. Simple enough. The bet is on that re-rating happening. The rationale is that as the integration success continues and those synergies fully phase in through Q1 2026, INDB's valuation multiples should start moving closer to some of its higher performing, already integrated peers, especially as that operating ROTCE stabilizes consistently above 13%.
Okay, long the stock. But here's the kicker. The way to maybe juice the return or hedge it a bit, simultaneously sell far out of the money, OTM, put options. For example, maybe target something like a $55 strike price expiring way out in late 2026.
Right. Why sell those puts? Because the options market, especially for regional banks, still seems to price in this, frankly, somewhat absurd level of systemic credit fear. By selling those far OTM puts, you collect premium that's tied to that misplaced pessimism. It effectively helps fund your long stock position, or at least provides a capital buffer against generalized, non-specific regional bank volatility. It's basically a bet on INDB's specific operational excellence, funded by the market's generalized, almost institutional dread about the sector.
Okay, so wrapping this all up, what does this mean for you, the listener? Well, the major takeaways from Q3 look like pretty comprehensive wins for INDB. the Enterprise integration. Successfully completed, already showing benefits in the margin. In NAM hit 3.62% and in growth, like that 13% annualized organic C&I pop. The company looks disciplined, hitting that crucial CRE concentration target at 295%, and they're managing capital effectively with buybacks and lower than expected dilution.
Yeah, Q3 really was exactly that stepping stone management promised it would be. Seems like you delivered.
But the true test of this successful quarter moving forward lies not just in hitting those cost save numbers, but really in the bank's ability to maintain that organic C&I growth momentum we saw.
Right. And maybe the ultimate sustainability hurdle is ensuring that roughly $160 million they still have in remaining accretable loan marks, making sure that rolls out predictably over the next 5 to 7 years. If they can manage that process smoothly while also organically increasing their core margin, well, then they can sustain this current level of profitability even after those purchase accounting tailwinds eventually start to fade away. That sustained execution, that's really the narrative to track through Q4 and into 2026.